The US dollar is falling, and not just by a little. So far this year, it's down more than 10%, marking its worst performance in more than half a century. As Morgan Stanley put it, the value of the US dollar against other currencies dropped about 11% in the first half of this year, the biggest decline in more than 50 years, ending a 15-year bull cycle. And while America's economy is still technically growing, the greenback's strength is fading fast. The question on everyone's mind is simple. What's going on, and should we be worried? The US dollar index, which tracks the dollar's value against a basket of major currencies, has been sliding steadily throughout 2025. According to Morgan Stanley, this drop marks the end of what they call a structural bull cycle for the dollar, one that lasted from around 2010 to 2024, a 14-year run that saw the dollar gain nearly 40% in value. That long bull market, they say, has finally come to an end. One analyst put it simply: we're likely at the intermission rather than the finale. In other words, the decline may not be over. It could just be the halfway point. Normally, when a currency falls, it reflects a weak economy. But that's not what's happening here. The US economy is still expanding, just not as fast as before. The issue isn't growth disappearing, it's that the conditions that made the dollar strong are changing. Morgan Stanley explains that rate differentials are a fundamental driver of currency strength. For much of the past decade, the US has had an advantage. Its interest rates were higher than those in Europe, Japan, or China, which made holding dollars more rewarding for investors. But now, that gap is closing. The Federal Reserve is expected to cut rates from 5.25% down to around 2.5% by the end of 2026. And as those rates fall, so does the incentive to hold US assets. The simple truth is that money follows yield, and if yields are dropping, the dollar follows. Growth projections are also softening. Morgan Stanley expects US GDP growth to fall from 2.8% in 2024 to 1.5% in 2025 and just 1% in 2026. When growth slows and rates fall at the same time, the demand for dollars tends to fade. Investors start looking elsewhere, toward faster growing markets or currencies offering better returns. And this shift, while gradual, adds up. But the interest rates aren't the only problem. Policy uncertainty is weighing heavily on investor confidence. After the 2024 US election, markets expected a burst of new economic energy. There was hope for strong expansion, capital inflows, and continued outperformance of US equities and the dollar. Instead, new tariffs, spending promises, and political gridlock quickly changed the picture. From April to June, the dollar dropped another 7% as investors reacted to the policy noise. Morgan Stanley pointed out that if we see more evidence that tariffs are increasing inflation, then it's possible the dollar will receive more support. But they also warned that recent evidence of labour market weakness, combined with policy uncertainty, remains a source of downward pressure on the dollar. In other words, the policies meant to boost the economy might actually be making the currency weaker. Donald Trump has expressed mixed views about the strength of the US dollar, but his recent comments suggest he sees a moderately weaker dollar as beneficial for the American economy. In 2025, Trump said, "I like a strong dollar, but you make a hell of a lot more money with a weaker one," acknowledging that when the dollar is too strong, it makes US exports less competitive because you can't sell tractors, you can't sell trucks. While he often praises the idea of a strong dollar for its psychological and symbolic value, Trump has also made it clear that a softer dollar can help boost exports and manufacturing, especially in an economy driven by global trade. In short, he doesn't oppose a weaker dollar outright. He views it as a strategic advantage when used in moderation.
Dollar falling so much, and are you concerned about that?
Well, I'm a person that likes a strong dollar, but a weak dollar makes you a hell of a lot more money. Hate to tell you, I don't know if you study it, but I study it.
I want you to say,
and if you look at the yen, so when we have a strong dollar, one thing happens, it sounds good. But you don't do any tourism, you can't sell tractors, you can't sell trucks, you can't sell anything. It is good for inflation, that's about it. And we have no inflation. We wiped out inflation.
As president, both in his first term and now in his second, Trump has pressured the Federal Reserve to keep interest rates low, criticised central bankers, and embraced tariffs as a tool to reshape trade balances. These moves naturally put downward pressure on the currency. None of this alone means Trump wants to abandon the dollar, but his willingness to openly criticise and interfere in monetary matters makes international investors nervous. Global markets depend on predictability, and when a US president seems comfortable with volatility, confidence in the dollar can erode. One of the most striking moves came in March 2025 when Trump signed an executive order establishing the Strategic Bitcoin Reserve and a US digital asset stockpile. Under this order, bitcoins and other digital assets seized by law enforcement are no longer sold off at auctions. Instead, they're placed in a national reserve alongside gold and other strategic assets. The government explicitly stated that these digital assets will be held indefinitely as stores of value. This marked a historic shift. For the first time ever, the US formally recognised Bitcoin as part of its financial reserves. While the size of this reserve is still small compared to the dollar and gold holdings, the symbolism is powerful. It adds legitimacy to Bitcoin as a store of value, something many of its advocates have sought for years. Still, this doesn't diminish the centrality of the dollar. Alongside the Bitcoin reserve, there has been renewed debate over gold. The US officially values its gold holdings at around $42.22 per ounce, a figure set decades ago. But the market price of gold is far higher, currently hovering around $3,500 per ounce. Some analysts and lawmakers have suggested that revaluing gold at market prices would dramatically expand the US balance sheet, unlocking hundreds of billions of dollars in value. Some proposals go even further, suggesting that this revaluation could fund additional Bitcoin purchases, creating a dual reserve strategy anchored in both gold and digital assets. While no such policy has been enacted, the fact that it's being seriously discussed reflects how unsettled the future of monetary policy has become.
The US dollar ended the first half of 2025 with its biggest loss since 1973. The dollar index, which measures the greenback against a back set of currencies of the US's major trading partners, fell about 11% from January through the end of June. Although the currency strengthened 3.2% in July, recovering some of the year's depreciation, Morgan Stanley research expects the decline to continue, possibly adding another 10% in losses by the end of next year. Behind these shifts is something deeper. The world itself is changing. A decade ago, roughly 63% of global foreign exchange reserves were held in US dollars. Today, that figure has fallen to about 55%. Countries are quietly diversifying, holding more euros, more yuan, even more gold. Meanwhile, trade blocs like BRICS, Brazil, Russia, India, China, and South Africa have expanded their share of global trade from 20% in 2015 to 35% today. Many of these nations are deliberately cutting their reliance on the dollar. Russia and China, for example, have begun trading energy and commodities in their own currencies. India is setting more of its imports in rupees. The less these economies rely on the dollar, the less global demand there is for it. This gradual shift might not feel dramatic, but its implications are huge. When countries don't need dollars to trade or store reserves, demand falls. And when demand falls, so does value. It's that simple. So what does this mean for everyday Americans? A weaker dollar has ripple effects throughout the economy. First, inputs get more expensive. When the dollar falls, it takes more of them to buy foreign goods. That means higher prices for everything from electronics and cars to clothing and food. Add tariffs on top, and the price pressure intensifies. Morgan Stanley warns that rising import prices could put pressure on inflation, complicating the Federal Reserve's effort to get inflation back down to its 2% target. For exporters, though, it's a different story. When the dollar weakens, American-made goods become cheaper for foreign buyers. That can boost sales for US manufacturers and farmers. As Morgan Stanley put it, on the positive side, the weaker dollar could be a boost for American exporters. So yes, there's a silver lining, but for the broader economy, the negatives outweigh the positives. Most American businesses and households rely far more on imports than exports. Then there's the issue of debt. The United States is running massive budget deficits again, spending far more than it earns. In 2020, that was justified by pandemic emergency spending. But since 2023, the deficit has been climbing again. Borrowing keeps increasing, and so do interest costs. During the pandemic, government borrowing was cheap. Yields on Treasury bonds were below 1%. Today, they're above 4%. Every time the government borrows, it has to pay more to service that debt. A weaker dollar only makes that burden heavier. The government effectively needs to print or borrow even more just to keep up. The same problem trickles down to consumers and businesses. A small manufacturer that relies on imported parts suddenly finds their costs rising. A family planning a vacation abroad realises it's hundreds of dollars more expensive. Every imported good becomes a little bit more painful to buy. And when those costs feed into higher prices, the cycle reinforces itself. Higher prices lead to more inflation, which leads to more pressure on the Fed, which leads to uncertainty about rates. And that uncertainty feeds back into currency weakness. So could this become a spiral? It's possible. A falling dollar can create a feedback loop. Weak currency leads to higher inflation. Higher inflation reduces purchasing power and economic growth. Weaker growth drives investors away, which pushes the dollar down further. Morgan Stanley warns that the second act for the dollar's weakening should come over the next 12 months. And if interest rates and growth continue to converge with the rest of the world, the dollar's slide could easily continue through 2026. Still, there are scenarios where things could stabilise. If tariffs drive up inflation too much, the Fed might pause its cuts or even hike again, restoring some rate advantage. A burst of stronger than expected economic data, say a surprise rebound in jobs or productivity, could also attract investors back to the US. And of course, global crises often push money back into the dollar as a safe haven. In moments of panic, investors still tend to run toward the dollar, not away from it. But in the absence of such shocks, the underlying trend remains clear. Less growth, lower rates, persistent deficits, and growing global diversification away from the greenback. Together, those form the foundation of a slow, grinding decline. So should we be worried? The honest answer is yes. But not panicked. This isn't the end of the US dollar, but it could be the start of a new chapter where America's dominance in global finance faces real challenges. Morgan Stanley reminds us that the dollar remains the world's most important currency for now. That phrase, for now, matters. The dollar's dominance has survived crises before, from the inflation of the 1970s to the financial crash of 2008. Each time, it bounced back. But each time, it also lost a bit more ground to its rivals. The real risk isn't a sudden collapse, it's erosion. Confidence in the dollar is built on stability, discipline, and trust. When those erode, recovery becomes harder. If deficits keep widening, if policy stays unpredictable, if inflation lingers above target, and if global trade keeps drifting away from the dollar, then over time its influence will fade. That doesn't mean the US is powerless. There are steps that could strengthen the dollar again. A more hawkish Federal Reserve stance could restore rate advantages. Fiscal discipline, actually reducing deficits, could rebuild global confidence. Clarity on trade and foreign policy could calm investors, and ironically, even global instability, though painful, could lift the dollar in the short term as the world seeks safety in US assets. But none of these are guaranteed. They require consistent, credible policy, and that's something markets aren't seeing right now. Ultimately, the dollar's decline is more than a financial story. It's a reflection of shifting global power. The world is diversifying. BRICS nations are rising. Trade is fragmenting. The US is grappling with internal divisions and a heavy debt load. And together, those forces are reshaping the global financial map. If the dollar continues to fall, the US will import inflation, struggle with higher borrowing costs, and face growing competition for economic leadership. But history shows the dollar has extraordinary ability to adapt. It remains the foundation of global finance because, despite everything, the world still trusts the American system more than any alternative. The key question is whether that trust can endure. For now, the dollar is down, but not out. The real test will come over the next 12 to 24 months as interest rates, inflation, and global trade flows determine whether this is just a correction or the beginning of something bigger. The dollar story isn't over yet, but for the first time in a long time, the ending feels less certain. And that's why, yes, we should be paying attention. If you found this breakdown helpful, like, comment, and subscribe for more.